Hello everyone! We, the Group 7 from the Financial Analysis and Reporting subject, are here to discuss to you about the topic liquidity and solvency.
Liquidity. What does liquidity mean? How does it work? Explain its importance. Liquidity refers to the company's ability to pay off its short term liabilities such as accounts payable that come due in less than a year. Banks and investors look at liquidity when deciding whether to loan or invest money in a business. Liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. The most liquid assets of all is a cash itself. There are two main types of liquidity, which is market liquidity and accounting liquidity. Market liquidity refers to the extent to which a market, such as a country stock market or a city real estate market, allow assets to be bought and sold at stable, transparent prices. Market liquidity is important for a number of reasons, but primarily because its impact how quickly you can open and close position. A liquid market is generally associated with less risk, as there is usually always someone willing to take the other side of a given position. While accounting liquidity is a measure of how easily an individual or business can pay their bills using all the liquid assets they own within a period of 1 year. That means comparing liquid assets to outstanding liabilities, it is the ability to pay off debits as they come due.
Easily determine on which assets can be liquid, we have an explanation of liquid assets and illiquid assets.
Liquid and illiquid assets. What are liquid assets? Liquid assets are assets that can easily be exchanged for cash, while assets are valuable positions that can be converted into cash. Not all of your assets can be sold for cash right now, or without taking a loss on the sale. Common liquid assets include cash, treasury bills and treasury bonds, certificate of deposits, bonds, stocks, exchange-traded funds, mutual funds, money market funds, precious metals. What are illiquid assets? Illiquid assets are not easily sold or converted into cash. Some example of liquid assets include real estates, collectibles, stock options, private equity, estates, intangible assets.
So there are three types of liquidity ratios. First is current ratio. The current ratio is the simplest liquidity ratio to calculate and interpret. Anyone can easily find the current assets and the current liabilities line and items on company's balance sheet. Divide current assets by current liabilities and you will arrive at the current ratio. The second one is the quick ratio. The quick ratio is a stricter test of liquidity than the current ratio. Both are similar in the sense that current assets is the numerator and the current liabilities is the denominator. However, the quick ratio only considers certain current assets. It considers more liquid assets such as cash, accounts receivables, and marketable securities. It leaves out current assets such as inventory and prepaid expenses because two are less liquid. So, the quick ratio is more of a true test of a company's ability to cover its short-term obligations. The last one is the cash ratio. The cash ratio takes the test of liquidity even further. This ratio only considers a company's most liquid assets, cash, and marketable securities. They are the assets that are most readily available to a company to pay short-term obligations. In terms of how strict the tests of liquidity are, you can view the current ratio, quick ratio, and cash ratio as easy, medium, and hard. Therefore, an acceptable current ratio will be higher than an acceptable quick ratio. Both will be higher than an acceptable cash ratio. All three may be considered healthy by analysts and investors depending on the company.
What is shown in the screen is a screenshot of Amazon's 2017 balance sheets, which displays its assets and liabilities in order of their liquidity, as well as its shareholders' equity. As you can see in the image, Amazon's assets are separated into two categories: the current assets and non-current assets. Current assets are as follows: the cash, marketable securities, inventories, and accounts receivable. The marketable securities includes publicly traded stocks, bonds, and other investments. Inventories are the products, finished goods, raw materials, and etc. that can be sold. On the other hand, accounts receivable is cash owed from sales to customers on credit. For most companies, these are four of the most common current assets. Their liquidity, however, can vary. For many companies, accounts receivable is more liquid than inventories, meaning the company expects to receive payment from customers faster than it takes to sell products in inventory. Our current liabilities, on the other hand, are accounts payable, which is the money owed to vendor and suppliers, the accrued expenses, and other, which is the money the company expects to owe to vendors and suppliers in the near future, and the last is the unearned revenue, also called the deferred revenue.
Solvency. What does solvency mean? It is the ability of a business to meet its financial obligations. However, it goes beyond a company's ability to settle its debts. Financial stability over the long term is also implied by financial solvency. How solvency works? A company's or individual's ability to meet its financial obligation is portrayed by their level of solvency because of this. Calculating a company's solvency using its assets less its liabilities, which equals its shareholders' equity, is the quickest method. Short-term versus long-term solvency. Solvency is the capacity to meet financial obligations over the long term. Liquidity, or the part of the company assets that can be swiftly liquidated, on the other hand, is the capacity to pay your short-term debts. Since a corporation may have strong liquidity but low long-term solvency, the term solvency always refers to long-term solvency. This would suggest that financial difficulties for the company may soon arise.
Solvency measures or ratios. Solvency ratio equals total assets divided total liabilities. Solvency often is measured as a ratio of assets to liabilities. For example, are there enough assets to pay the bills? In these ratios, the best way to measure solvency is to include all liabilities. Accounts payable, taxes payable, loans payable, leases payable, and anything else the business owes. A firm's solvency ratio can affect its credit rating. The lower the ratio, the worse its rating can become. A lower credit rating means it will be harder to borrow money. There are two ratios that measure solvency, which is also used to measure liquidity ratio. Number 1, current ratio equals current assets divide current liabilities. The current assets are cash accounts receivable, inventory, and prepared expenses. Other long-term assets like equipment aren't considered in this ratio because it takes too long to sell them to get money to pay the bills. And they won't sell for full value. In order to be solvent and cover liabilities, a business should have a current ratio of 2 to 1, meaning that it has twice as many current assets as current liabilities. This ratio recognizes the fact that selling assets to obtain cash may result in losses, so more assets are needed. Number 2, quick ratio equals cash plus accounts receivables plus marketable securities divide current liabilities. The quick ratio uses only cash and accounts receivable, as these assets are the only ones that can be used to pay off debts quickly. Case of an emergency cash need, the quick ratio is a 1 minus 2 1 ratio, meaning cash and accounts receivable must equal the amount of debt.